Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're looking at Genie Energy Ltd, ticker GNE. This is a company that I bought into heavy in July of 2022, and by August I had 100 shares of the company, and I liked what I saw, and we'll see if I still like what I see with the company. Just like last time, we'll start running through my spreadsheet to take a look at where my position sits today. So I own 100 shares that I bought at an average cost of $9.98, and it's currently sitting at $15.32. So I have a total investment of $1,532 when I initially paid in $992. I had calculated a fair value for this stock around $21. We'll see if that's still the case, but even then, I'd be looking at a $500 upside to my position. It pays a dividend of 1.96%. Based on the price that I bought it at, I'm getting a 3% yield, or 30 cents per share per year. So I get a total of $30. It's 2% of my dividend income. Off of dividends and capital gains that I've realized, I've made $43.62. So I've had 15% of my investment actually paid back to me. So in total, I've made about $765.62 off the stock for a 77.2% return. So I'm sitting on some pretty hefty gains here. I still, based on my last calculation, have some upside to this stock, but that could always change. That's why you need to look into the earnings and see what's going on. The market seems to love it. The stock's way up today. The earnings were a few days ago. But let's take a look at the chart and see what we're looking at there. Here we have the chart for Genie. As you can tell, it's a relatively new stock, emerging on the markets in October of 2011. They are a dividend payer. They do take some breaks here and there. Like all of 2021, they didn't pay a dividend. They brought it back in 2022. And they had started with one, but took a break in 2012, brought it back 2014, paid a little bit, stopped. So they're not a very reliable dividend company. They're definitely more of a value or a growth play. We see that they kind of trade up and down a lot. The highest that they've ever reached is $16.80 back in 2013. And today they sit at $15.27, riding a very, very large uptrend since about the end of 2021. Throughout all of 2022, they were just full steam ahead upwards. So let's take a look at the numbers and see why that is. And here we have the financials for the company. As we can see, the longer term trends are very good. There's one yellow flag, which is their liabilities. And then in the short term, their revenue is kind of a red flag. There was a decline this last year. Overall, they're not very good at driving revenue. That is something that I want to see change if I'm going to continue to hold on to this stock. The cost of goods, they've been very good at decreasing. They're able to cut their cost of goods down from $232,000 to $160,000 for about the same revenue. So much better margins. Their gross and net margins had moved from 26 and sub 1 to 49 and 27. Some very good moves on those numbers. The gross profit, of course, with the lowered costs, has been increasing at a very good rate. Net income doubling, tripling up year over year. I don't think that trend's going to continue. It will slow down for sure, but that even slowed down would be good. Expenses, they've been amazing at cutting their costs. Their EBIT has been doubling year over year, going from 6 to 33 to 77. So I'm excited to see what it comes in this year at. I mean, for a similar trend, they need to come in over 100. Gross profit has been growing 23% year over year. Net profit 217 year over year. Earnings per share 222%, from 10 to $1.06 to $3.35. And there are no analysts for this stock. 0 analysts. So can't give a forward number. They currently sit at a PE ratio of which is nothing for the earnings growth that they've been bringing in. But maybe they've cut costs as far as they're able to. And if they can't drive that revenue, we're going to see declines or stagnation. So that is something that I want to keep my eyes on. The fair value based on history, I mean, this stock in the past, it was 70, off that 10 cents, it was 76 PE. If we cut that out, I mean, this stock does typically trade around the 4 PE level from 3 to 5. And we'd be looking at a $14 fair value based on that. As for assets, they're great at growing their assets, 21% year over year. Liabilities they decreased them last year, but they're up quite a bit from 2019 levels, which gives us a 11.4% year over year growth. Their book value is positive, something that we really like to see, growing at 43.47% year over year, which is some great growth. Moving from 56 to 165. I'd like to see that continue. Free cash flows, they've been great at driving their cash, 73% year over year. Oh, for that book value, $19 will be good if they can continue this trend, 27. Free cash flows, $61.30 if they continue at the pace that they're going, 106.58. Share count, they've been buying back shares very well, nearly 0.5% a year. Shareholders' equity has been increasing 33.5% year over year, 70 last year alone. Dividend, as I've said, they're kind of here and there on the dividend. Currently yields 1.95%. That's why it's not a big dividend stock. It's a nice cherry on top. I mean, you're paying for all of this growth. There's no way that I could say that this is a sell. Even if these earnings come in bad, you can't take one earnings and have that be the deciding factor unless their guidance is just awful for this year and you think that it'll drive it down and you can get back in at a lower price. I'd say the dividend doesn't really matter, so the absolute bottom would be about $14. And at the top, I don't think the cash flows are all that expensive and should be factored in too much. So the top has to be in the $20 range. Like looking forward, the book value, if they're able to continue on trend, we'd be looking at 27. If they can continue these numbers as we've seen in the past, it'd be even higher. We can see that the ROE has increased 73.5% this last year. It's gone from 3.6 to 48% from 2019 to 2022. And that 48 is right about where we like to see it. This isn't an issue of debt. Their debt is pretty low. This is pure return on equity for shareholders. And then we have the Lynch formula says that this stock is incredibly undervalued. That is, if they can maintain the growth rate that we've seen on the stock. Let's get into the earnings. As usual, I've already taken a peek at these earnings, and I see some good and some bad. For example, revenue increased 22.5% to $105.3 million compared to almost $86 million the same quarter of last year. But their gross profits decreased 29.3% to $33.3 million from $47.1, meaning their margins decreased to 31.6 from 54.8. Total income from operations is down big time, down 58.2% from 27 to 11.3, and their earnings per share decreased to 14.3 million or 54 cents per share from the 17.5 or 67 per share that they had seen last year. And here we have some of the numbers. Total revenue is up 22.5%, as they said above. This is mostly driven by electricity, up 25.4%. They also saw just a total increase in retail of 20.9%. Oh, their renewables saw a huge increase too, going from 2 to almost 4, nearly doubling. So net income down 18.5%. We had seen that they were doubling, tripling up on that year over year. We see adjusted EBITDA is down 55.6%. And that is another number that they were doubling up on every year. So looks like this year will be the change in the trend. As for the balance sheet, total assets increased from 277 to 293. That's good to see. Total liabilities from almost 104 to 107. Current liabilities are up about 5,000. Remember, guys, these are in thousands. Stockholders' equity is up from 187 to 199. And then there's the revenues. So total revenue we had seen was up. The cost of revenue almost doubled. So their gross profit ended up being lower off those higher revenues. So those leaps and bounds that they made in those cost of goods last year might have dried up. They might have just gotten lucky off some resource costs. Basic earnings per share of 44 cents and diluted of 42 compared to the 74, 75 of last year. Share count is down. They are going to pay that dividend again. Stock-based compensation is up. That's something that I haven't really looked at, that I want to start looking at and factoring in, because that's something that can really drive a company down, is paying stock-based compensation to the employees. So cash and cash equivalents are up from 93 to 109. I really like this view that they give here, where I can look at all of the quarters of last year and the total numbers for 2021 and 2022 and see what's really going on here. So we see this 31.6 gross profit is pretty low. I mean, it's higher than they came in 2021, but way lower than they came in at any point in 2022. They just had an exceptional year in 2022. Exceptional year. Like this operating margin, 31% in Q1, 7.5% in all of 2021, 3.7 in all of 2022. So 6.8. That's not bad. That's more in line with all of those. This earnings per share is the lowest of all the numbers that they give us. Adjusted EBITDA is not the lowest. Q2 of 2022 was the lowest. So what are my thoughts on the stock? I'm going to give it a hold. I still think that it has potential to get up to $20, which is a 25% upside from where it currently sits. I own 100 shares. I might even buy another 100 if it dips back down. Apparently, these earnings didn't drive it down. There are no analysts reporting on this stock, so it's kind of a hidden gem. If you're a fan of Peter Lynch, this is exactly the type of stock that you're looking for. Something where it's nothing but green flags. No analysts are looking at it. You can just grow your position over time, and hopefully the market will start to realize what's here and it'll become something bigger. I'm definitely going to be looking forward to seeing how the quarter two results come out, because that will help make some more decisions. If they're still seeing higher expenses and lower earnings, then I can rerun some numbers and figure out what I'm going to do at that point. But for now, it's a hold. Potentially a buy. So I want to thank you guys for watching. Please like, comment, subscribe. Let me know what you want to see, and I will catch you next time.